my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. As I said last time, the monthly key reversal up for July had really started something. It created the chance for a bullish halfway hesitation during the latter part of July with a target in the 780 area, which was achieved. Then during the first part of August we had the setup for another bullish halfway hesitation, a smaller one, with a target X in the 794 area. This was on the way to being achieved until the start of this past week, when prices made an indecisive doji cross right at the top of the market. Not the sort of thing you'd want to or wish to see if you're a bull out there. Tuesday, the very next day, we had a combined bearish engulfing pattern. Not that hard to achieve really, on the back of a doji cross, but also a bearish long black Marubozu. This was also on the back of something else I pointed out last week, testing up and failing at the upper time, currently 790, with a March to July bullish shift pitchfork. Now this action set the tone for the rest of the week, as on Wednesday the market broke down through and closed below the July uptrend, currently 763, thus retiring it, and off my chart at the end of this commentary. Prices have since dropped off down to the March 2014 high at 725. Now, there is still a chance for a bull channel from the mid-July action, but it very much depends on what happens by this coming midweek. If we continue low, then target X may actually well be finished, and we see a challenge to the middle time, currently 704, of the same March to July bullish shift pitchfork. If not, then we'll have to start questioning the bullish incentive. Right now it is a bit battered and bruised, but still alive, as have hardly dented the monthly key reversal up in July. Chicago corn. First off, I must apologise again for some of the red labelling on the daily chart. It's a function of my charting package that sometimes happens, and something I have no control over. I just want to add that just because they are red doesn't mean they have any more special implication. So here I had been going on about a bearish bump and run reversal pattern, which I eventually retired last week as the market made a bold move higher 2 Thursdays ago, up as high as the medium moving average, currently 587, and breaking the June to date downtrend, currently 573, but admittedly failing to close over either. It was nevertheless a bold move, and I thought it may well have weakened the upside enough that we could see another attempt higher, especially over the medium moving average, as we have, after all, had lots of ammunition gathered over July and August below the market. However, it seems this move higher was a possible last hurrah, and a false break on the upside, as apart from one indecisive doji cross and indecisive spinning top apiece, the market has fallen and fell below the optimized and broken 2021 uptrend, currently at 569, and also the August 2020 to date uptrend, currently at 547. Most importantly, punched down through and closed below the long moving average, currently 541. This break below the long moving average hasn't happened since really November 2019. Questions now are, will the market exploit this move lower? And if it does, which pattern will it choose? To exploit it is simple. Just close again below the long moving average. Ideally, it would also help if a break and multiple consecutive closes below the combined 61.8% absolute Fibonacci line at 525, which is also the 2014 high. I wouldn't be confident of anything that couldn't take that on and deal with it. Next is what pattern or patterns are showing out there. Well, there are two main patterns: a sideways triangle or a descending or a descending triangle. The sideways triangle is the one formed topside by the 2-pointed downtrend, currently at 587 from the start of July, and the old August 2020 to date recently broken uptrend with its partner, the long moving average. This has in its favour the break below the uptrend, but not a break below the key 61.8% absolute Fibonacci line. In any case, this would give a potential target X in the 509 area, below all of that. The second pattern type is a descending triangle, with the original downtrend from mid-June, currently 573, that had the false break higher, and with the baseline being the 61.8% absolute Fibonacci line at 522. You can see from this that we haven't broken the baseline as yet. However, should we do so in the next week or so, then a potential target would be in the 459 area, a much lower potential move. However, as the baseline hasn't been broken or even really breached, then I've chosen not to mark it on my daily chart. Just remember it. It all now very much depends on what the next few days bring. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Service International Limited. And here comes the final bit.